Hello, I'm Joe DeLisi, and welcome to the Joe DeLisi Financial Advisor Podcast. Today is bonds day, the case for bonds, the case for fixed income, which, the subtitle of this is going to be, it's a tool, it's not a star performer. But in light of all the scary stuff out there with tariffs, I think it's actually pretty timely that we talk about bonds or fixed income and what role they actually play in portfolio development. So just a real quick, 2-second on the tariff thing. Look, here's the deal. Nobody knows what is going to happen with tariffs. If you look at tariffs, actually, there haven't been that many placed since really like World War II. Prior to that, there were many more. So there's a lot of experts out there. I have no idea what's going to happen short term. It could go down, sure. It could go up, sure. But everything is true with the way that we always talk about the market, which is the next 20% might be up or down. We don't know. The next 100% movement is up. In other words, the market has doubled many, many times. We've seen it, but the market, an entire market, has not gone to zero. The S&P 500 doesn't go to zero. Not likely. So markets generally long-term will trade on obviously cash flows and supply and demand and economic principles. It doesn't matter if we're talking about US or international, emerging markets, etc. That's just true. Short-term, a lot of times it can trade on emotion, and we don't do that. I'm not going to do that to you. I will not be your weak link. I will walk you through the emotion. I will help you through it, of course, and things do get scary. But we're not going to panic. So today, let's talk about bonds and one of the reasons why we don't have to panic. So conventional wisdom often positions bonds, and pardon me, I'm going to apologize ahead of time. I have the flu that everybody has around the country, and I can't stop and hit the cough button every time. So we're in it together. Okay. So back to the conventional wisdom. Position bonds is a cornerstone of a balanced investment strategy. But the question we want to tackle today is, should fixed income primarily serve as a tool to reduce volatility, or rather should it be a means to generate returns? My argument, yeah, it should be to reduce volatility. Absolutely. Fixed income should be short-term and defensive. It should not be a long-term return engine. Historically, bonds have been pitched as the yin to equities yang, a very stable income-generating asset class to balance out the risk and volatility of stocks. And for decades, this narrative has worked. The so-called 60-40 portfolio, which would be combining 60% stocks and 40% bonds, has delivered reliable returns while helping to mitigate risk. But let's consider the recent environment. Look, interest rates had been, I should say, historically low, which really will always cap the income potential of a bond. When rates go up, bond prices fall. This is like investing sort of 101 for advisors, but I feel like advisors miss this too. So I'm going to say this again. When rates rise, interest rates, when they rise, bond prices fall. Why? Well, let's break it out. Let's consider it. If you buy a bond for 20 years that's fixed at 2%, so you go to the market, you buy a bond from a AAA rated, a very quality bond from either the government or from a corporation, and they agree to pay you 2% for 20 years, well, then you're going to get 2% on your money for 20 years. But if the next week, the same company issues another bond, a new bond that can be had for 20 years, but at 5%, well, who wants your stinky 2% bond? Nobody would, at least not for what you paid for it. Okay, so if you paid $1,000 or $10,000 for that bond, maybe if you just go to try to sell it on the open market, maybe you'll get, 70% of what you paid. So, the people who are buying that, they're going to discount it right away. They'll get the interest and they'll get the full amount at maturity, but nobody's going to give you 100% of the price you paid last week for a rate that's low in a new market environment. And this is exactly what happened a few years ago when a lot of banks failed because they had exposure to very long-term bonds, 20 years, 30 years. So given these dynamics, relying on fixed income for return, like those banks did, like a lot of clients ask me to do for them, that can be very detrimental to your portfolio. So again, let's kind of break this down. Why does fixed income, why do bonds, why can they work as a short-term volatility reducing tool, like downside volatility, like what we might be facing this week? I don't know that that's going to happen, but it likely could. So number one, short-term bonds offer liquidity and flexibility. So short-term bonds, fixed income securities like T-bills or investment grade corporate bonds are less sensitive to interest rate changes. Okay, they provide a cushion during market downturns while preserving liquidity. So this can make them a great parking spot for cash or a source of funds during opportunities in risk assets. So, pardon me, if you think about the portfolio that I likely run for you, if you're my client, if you pull it out and you look at the fixed income we own, whether that's 5% or whether it's 40%, whatever the percentage is that I have you in bonds, those bonds are high quality and short-term fixed income. Now, the rates can still go up and down, right? But if you own a fixed income bond at, say, 3%, but it's only good for a year, the fluctuation on that, if interest rates go up, is not nearly as bad as if you're locking it in for 30 years. So we like short term. If we're looking for big returns, we're not going to bonds, we're going to stocks, right? We're going to hold those stocks, those equities. But for bonds, we're looking for resilience in downside volatility markets, which brings me to number 2, volatility management. When equities are in a free fall, when it's scary, short-term bonds acts as that shock absorber. So a 2% return or 3 or 4% or whatever you're getting on your fixed income in the portfolios right now, it might not sound exciting, but in a bear market, losing less means having more capital to reinvest when prices are low, which is exactly what we do. So when stocks go down, we rebalance for you. When do we want to buy stocks? Well, we want to buy them when they're low. So when everyone else is selling, we want to buy them. If you're a long-term investor, honestly, anything outside of 3, 4, 5 years and over, that's what we're looking to do. Number 3, lower risk of principal loss. So longer duration bonds expose you to that duration risk. That's what we talked about before. When rates go up, bond prices go down. The sensitivity of bond prices to interest rate changes are very high. It's a lot of sensitivity when you got that long-term duration, but sticking with short term, we can help mitigate that risk and maintain better control over the capital. So let's look at why chasing returns through bonds is flawed. Number 1, inflation in real returns. Even modest inflation can significantly erode the real returns of fixed income. So like a 3% return on a 10-year treasury bond isn't appealing when inflation is at 4, or 4 or 5% T-bills when inflation is 11. Investors seeking real wealth should focus on equities, like we mentioned a minute ago, or maybe alternative stuff, but not with us. We're not looking for alternatives. We're not looking for commodities. We are looking for equities for growth and fixed income for safety and reduction of volatility. So the other reason, I'm beating a dead horse here, but the reason why we don't want to look for these the returns in bonds is because you have to go long. And long-term bonds lock you into low yields for years, leaving you vulnerable to rate hikes. If you're buying a 30-year bond at today's yields, you're betting against economic recovery and monetary policy adjustments. And furthermore, and this is big, if you look at long-term government bonds since 1927, so hear this, okay? This is I should have probably just led with this. If you look at long-term government bonds since 1927, they've returned 5.09%, according to the Fama French Research Index. If you compare that to 5-year U.S. Treasury notes since 1927, your return was 4.85. So 5.09 for long-term, 4.85 for 5-year. So not much difference. And here's the kicker. That 30-year bond has twice the standard deviation, which is a measure of volatility, than the 10-year note. So you're not being compensated for the risk you're taking. And then number 3, and the last one, opportunity cost. We don't want to be allocating too much capital to long-term bonds or really bonds in general, because it means on missing out on higher returning opportunities in equities or real estate or small business growth if you're a business owner. So how should we approach bonds? Well, number 1, consider treasuries, money market funds, or high quality short-term corporate bonds with maturities of like less than 10 years. This is what our portfolios hold. Focus on your goals. And this is really key. Focus on the purpose for the money that you've got. Consider using fixed income to strategically manage your cash flows and hedge against equity risk. Don't treat it as a primary driver of returns. It's there to reduce volatility. It's there to help us rebalance, not to generate return. So to sum up, fixed income bonds plays a crucial role in a well-diversified portfolio, but its role is not to generate returns. Now, we've said that probably 15 times in the last 10 minutes. It can be more effective, or it can be a more effective tool as a short-term defensive position to reduce volatility and provide liquidity, but not long-term and offensive. Just remember, every asset in your portfolio should have a purpose, and it does if you're my client. Bonds' purpose is stability, not growth. So the next time you're revisiting your asset allocation, just ask yourself, is your fixed income allocation helping you achieve your goals or holding you back? And that will depend on your time frame and your propensity for risk and all the things that we've done one-on-one to build that portfolio for you. And that is the take on bonds. Questions, comments, fears of markets, as always, please reach out to me. If this helped you, share it. Just hit that little share button, copy the link, shoot it off. Now for compliance. Registered Representative, Financial Advisor, Park Avenue Securities, LLC, Pass OSJ 5280 Carroll Canyon Road, Suite 300, San Diego, California, 92121-619-684-6400. Securities, products, and advisory services offered through Pass, member FINRA, SIPC, FINRA, Financial Representative of the Guardian Life Insurance Company America, Guardian, New York, New York. Pass is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of Pass or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC, California. Insurance license number OD34103. This podcast is for informational purposes only, not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that the individual situations can vary. Therefore, the information should be relied upon only upon coordinated with individual and professional advice. Guest speakers and their firms are not affiliated with or endorsed by Pass, Guardian, or Westpac Wealth, and opinions stated are their own. Guardian subsidiaries, agents, employees do not provide tax, legal, or accounting advice. Consider your tax, legal, or accounting professional regarding your individual situation. All investment strategies can take risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value both due to real and perceived general market, economic, industry conditions. This material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual situation, which you otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged and one cannot invest directly in an index. 756-8122.1 expires January 2027.